Hey guys, how are you? My name is Brett Manning, and you know me as Chart Trader on the site. I post under the tickers Chart and ETFXX. And I want to just start off with a basic introduction, a little bit about me. I've been actively involved in markets for a bit over a decade. And check the sound here. Okay, great. Sound is good? Okay, I started in the futures markets writing programs for systems trading for trying to teach a computer, basically, how to beat the NASDAQ 100 and S&P 500 futures markets. I started that right around or just after 9/11 in 2001, which is certainly an interesting time to be involved in markets. But that led to a few conclusions that stay with me to this day and really kind of forms the basis for some of what I do. And a lot of it is actually something that's a reaction to the process of trying to be overly systematic about market behavior and some conclusions that I've kind of drawn over the years. And I will go into that a little bit more in a few minutes. But the first thing I'd like to do is take you for a kind of tour through how I set up my screens and how I follow market action each day. So here's how I watch the markets. You can see 5 monitor screens. I've got briefing on the top along with a miscellaneous web browser and 3 data screens across the lower 3 monitors. And I'll get into exactly how those are set up in just a minute. But first I just want to make the point that on that miscellaneous screen, oftentimes what's there is the feedback screen that we have coming in from what you guys send through the Talk to Us button. And my email also responding to what you guys send in. And here is here's my email address, bmanning@briefing.com. You can also send something into briefingtrader@briefing.com. And I guess I just want to start off by making this point. This service is fully interactive, and I think that one of the main features that you're paying for with the Trader service, and that I frankly don't think people take advantage of enough, is that aspect of it. You can email me literally anything, anytime you want, or anybody on the team, and just send in your thoughts, send in questions, whatever you'd like, and you can send it right to my email or to the trading email, or you can use, you see the picture down here on the top of the screen, this is the Talk to Us button. And you can just go ahead and click on that and send us your thoughts throughout the day. A lot of people do use it, but I think a lot of people don't and maybe don't realize how interactive we mean this service to be. So that said, let's move on. I want to just go quickly over how I set up my briefing, and I do use it all day. And it's always on that, that top monitor, this one right here. It's always sitting there. And the way that I set it up is I use the dual in-place setup. So I've got 2 columns of information. And on the left side, I have everything unfiltered and full comments, because you can choose whether you want the full body of the comment showing or just a summary of it or just a headline. I leave the left side full comments, and I leave it completely unfiltered. So basically all the news, all the companies, all the trading calls, all the commentary, all the technical comments, all the summaries, everything. And on the right side, I have it selected just down to a few things that I want to make sure I see as a summary of the sort of tone of things. So I filter that down to trading calls and commentary from my teammates, economic data, anything marked top event, technical comments, and any of the columns that we write and post to the page. And I set this one on headline only so that I can see the greatest number of topics showing at the same time. This basically ends up working as a kind of a summary of market tone throughout the day for me, because it helps me keep me in the right frame of mind. I see what other people are looking at, what other people are focused on. I can see what's working for them, what's not working, what I agree with, what I don't agree with. And sometimes I don't agree with the calls that other traders are putting up on the site. Sometimes I really do agree, and I don't agree with what I've been doing, and I kind of see that I've been in the wrong mindset. And it kind of helps me keep me in check. So that's how that screen works. And moving on. Let's take a look at the way that I set up the market interface, so you can see basically how I approach following the market in terms of actually what it's doing. These are the bottom 3 screens, and I've got a system designed to allow me to keep a really big picture view of things going from left to right toward a focus market. And the idea is basically to be able to focus on something, but at the same time to not be in a situation where I'm going to lose focus or perspective on what the market's doing as a whole. So all the way to the left screen, probably the most important one for keeping big picture perspective on things. This is the top-down macro cross-asset view. And that allows me really at a single glance to be able to see how markets are correlating together across the whole asset spectrum. As you can see, I've got the S&P futures, the NAS futures on the top, and then crude, gold, the financial sector in the middle, and on the bottom there's the euro bond market and copper. And actually yesterday provides a pretty good example of how this was useful. When we topped out and we started to dive, starting this whole corrective wave, I was able to post on the site that I saw commodities markets cracking really badly and equities were still holding up, but it looked to me they were holding up on a pretty poor pattern structure. And so I posted basically saying that I thought the commodities markets, it was just getting too intense. It was getting too in the red, too hard, and I guess there were even some rumors floating around about maybe a commodity fund blowing up. But which I actually anticipated the day before in the chart book. These things have been really underperforming, and once something in a risk-on environment, if you've got a whole class of assets that are underperforming, people start to get a little bit edgy, and you can get a spate of redemptions, and some of these markets really aren't that liquid. And when it starts rolling that badly, you get somebody in trouble, and it can take everything down. And I really believe that was one of the big factors in rolling us over yesterday. But with a screen like this, I could see it coming because I saw that sort of big picture. I wasn't just sitting there staring at one or two stocks. This is always up all the way on the left side of the screen, so I'm always able to see basically what every market is doing from a top-down perspective. And it's a useful way to organize things. Now in the middle screen, this is where I have the higher time frames for the focus market. So the middle screen and the right screen basically all gear me toward a particular focus market. And that comes in the context of what's on the left screen, which gives me that kind of top-down perspective. So in the middle screen, I've got the basic info about a company, and I've got the daily chart on the bottom, the weekly chart on the top left, and a 30 or 60-minute chart on the top right. And I call this one a scrunched interval chart because it's got the intraday data, but it's scrunched up. When you put it on 60 minutes, you can see about a month's worth of action, but you're seeing it with the patterns of intraday swings involved too. And I would say over the years I've come to believe that that's probably the most important chart that I use in terms of really being able to identify a setup. Because you see the pattern on short time frames, but you see it in the context of the trend that's been going on or the range that's been going on and the shape of it. So that gives me that's probably when something really catches my eye and I see and I get that really strong sense of conviction, I know what's going to happen. It's usually from that chart, but it comes in the context of everything. And the third screen all the way over on the right, this is where I have what I call the timing chart or the read chart, and it's usually a 1 or a 3 or a 5-minute chart, and it's linked all together with the charts on that middle screen, the daily, the weekly, and that 60-minute scrunch chart. And all of this is linked to these quote boards that you see. Basically, this is all the way on the right in this column, this is my macro watch list. It's got a lot of futures markets, currency markets, commodities markets, and down here is basically the equities that I'm following. Now these watch lists are constantly changing, constantly evolving, and the stocks one in particular is organized by sector. I've got discretionaries and technologies over here, some industrials here, materials, energies, transports, financials. I don't follow a lot of healthcare as a trader, but that's how that's organized. And these quote boards, I use eSignal. These quote boards are actually linked to the charts, so any one of these that I click on, it immediately loads the charts into this read chart as well as the daily, weekly, and the 60-minute scrunched. And that's how I see the markets. Now, I'm not necessarily saying that you should run out and spend a bunch of money and reproduce the same type of setup at your home. And everybody has their preferences for this sort of thing, and people develop completely different styles. But this is I just want to introduce you to what I'm doing when I'm watching the market during the day. And one of my points really is I post a lot of general commentary on the markets. We had one today where I started to read the NASDAQ 100 futures as probably coming into the 50-day average, and in my mind, the way that it was trading, it was probably going to break it. I felt like that's the sort of market we had today, and that goes back to some comments I put out, starting a couple weeks ago for what I call the broadening top range in that market. And as it started to come down into that 50-day average, I posted on the site that I believed it was going to probably spike through it and flush orders out and take us down into the 2,700 area. And I guess the point I want to make right now is when you see those sorts of comments, know that it's coming in the context of this kind of level of perspective on things. So you know what I'm watching and maybe gives you a better understanding of where that feeling is coming from and whether or not you want to play with it. Okay, so now a little bit more on my approach rather than just how I watch the markets, my approach to trading. I trade just about everything, frankly. I've been at this for a while, and I've gone through periods where I focus on different things. But the way that it works out for me is it depends on the context of overall volatility as far as what I'm looking at. I tend to do extremely well in very volatile markets. Probably the best period I've ever had was from late 2008 to mid-2009, and strictly was trading the futures markets. A lot of S&Ps, a lot of NASDAQ, some currencies, some crude oil, some gold, some silver. And that sort of market, we had the VIX up at that point, 60, 70, 80, just at historic levels. And that sort of situation, and basically, I want to be trading something that's a big liquid market that's moving a lot. So when we've got what I put here on the screen as stormy seas versus balmy seas, this is a kind of division in the VIX. And I show a picture of it right here. You can see the VIX charted right here. That's the CBOE Market Volatility Index. For those of you who don't know, you should definitely look into this and understand it. The stormy seas period, when I see the VIX above this 22.5 area, now that's just sort of an arbitrary generalization, but that's the situation where I feel like I can be trading the S&P futures or the NASDAQ futures because they're going to have enough of a range, and that's already the biggest market around, and I'd rather be trading the biggest market that has a large range. So you won't normally see me trading too much in small cap stocks. I like to be able to read the tape. I like to be able to get a feel for the order flow, and I feel like there's just not a sample size that's big enough for that sort of thing when I'm looking at a small market. But I really like volatility at the same time. I like something to move around a lot. So when I find something really big that's moving around a whole lot, that's what I want to be trading. So when the VIX is above this level, that means I can go ahead and trade the mass market, which is what I really want to be doing. However, when the VIX is down lower, like it is these days, below 1750 about, you've got this balmy seas situation, as we do now, and really, to get volatility, you have to dial it down and look for individual stocks. So I've traded a lot of Apple, a lot of Netflix, a lot of LinkedIn, stocks like that. Things that move around a lot, that are trading plenty of volume, anything that's in play. HLF for a bit there was great. But again, so this is a kind of division in my trading focus. So you'll know if we get, let's say this rolls over a bit further and we really start to get people more nervous, we see that VIX spike up back above 20, 25, who knows, maybe on the sequestration, something, then you'll probably see me shift and be doing a whole lot more in ETFs and futures. Okay, now, beyond that, I want to get into a little bit of how I see technical analysis. Now, I noted in the intro slide that I got my start in programming trading systems for the futures markets, and that taught me a few things that I want to kind of reference now. I don't use indicators based on price, pretty much at all. Things like RSI, MACD, and this is because I did so much programming with them for a while that I came to understand when you break something down like that on a level that a computer can understand, and that takes a lot of breaking down because computers are so smart, but they're so stupid. And when you try to teach a computer how to do something, you have to break it down into endlessly tiny steps of analysis. And there is no better characterization of a hard right edge, the idea of a hard right edge on your charts, than when a computer is going through an iterative sequence with a 1-minute chart. Because it has literally no idea what's coming in front of it, and it only has the close of that bar, and it's constantly recalculating the data point and then doing the input-output sequence, and then recalculating the data point, and then doing the input-output sequence. And when you break it down to those steps and you throw a ton of data through it, you find that there's really just not a lot of, there's just not any extra information conveyed by indicators that are really just based on recalculating price. And most of them, I think, are just kind of eye candy. And when you look at RSI over time, it looks like it's constantly making this dip low right at a point where something's making a low. And there's no golden line with it. So I think most of the time people get drawn in, as I did for a while, into looking at an indicator like that. It's just summarizing the price data, but it looks like it's constantly catching these lows. But when you do an iterative sequence like that, and you have a computer do it over and over again, that signal's really not there in time to have caught the position. Not enough to make it worthwhile. And that's the other good thing about programming trading systems, is you start to get an idea about broad sample dynamics. So you see the sort of thing that works over the broad sample, which as a trader is all you really need to be interested in. So what works over the broad sample to me is a more inferential, intuitive kind of process. I use pattern analysis, I use volume, I use sentiment data, which we'll get into in a bit, and I use a lot of gut feeling. And I think that the gut feeling side of this is really, watching markets every day, all day for a long time, and trying to teach a computer how to watch markets for a while. I think kind of instilled in me a little bit more of an intuitive sense of just the types of things that markets do, particularly when there's a lot of volume. When there's not a lot of volume, it's really very difficult to characterize markets as having something that they generally do. It's much more random at that point. But when there's a lot of volume and a lot of movement and a dynamic that I call serial correlation, when movements are correlated with each other, when a market starts to get a hold of people and whip them around and move them around, and people start to react to what just happened in the market rather than reacting to outside information in the world. So when you get a lot of volatility and you get a lot of volume, you get this factor of serial correlation, and I think that it makes it a whole lot easier to just trade on gut feeling and on feel. And if you've been trading for a while, it gets easier and easier. Okay. So next I want to go into a particular setup here to just give you some idea of how I think about these things. I had this stock in late January on a fade after its monster move off earnings, when it blew up through the 150 level and just kept on going. I actually had a great fade position, got it just above 175. And the basic idea there is I felt that it had panicked out shorts badly enough to really shake out most of the weak hands who were trying to fade it first without letting the strong hands that I knew would be coming up underneath it to trail a bid. It accelerated too far away from them, so it would need to drop back to them after forcing that big flourish of a squeeze into 175. And then we got a triangle consolidation after that short, after I put the position on, that I eventually was able to spy out and switch, and then we got long for the breakout. So I just kind of want to go through how I looked at that pattern as it was developing. Okay, so here is the entry. I'm showing this on a very, very short time frame chart right now. So this is a 1-minute chart, and this is from the 28th when I put the original short on. And you can see how tiny the time frame is here if you imagine the larger pattern. Here's the larger pattern. Here's the big pop-off of earnings. It comes up, and this short was actually right there. And the reason I did it where I did it is because I've been looking at this level, and I started to watch it really closely that morning. And I saw some sellers in this area, and I knew that people were still sitting there trying to short it. And once it flushed up through 175, which was the level I was looking for, and I felt like it didn't immediately just blast to 180, I felt like probably the really weak-handed shorts were mostly blown out of this one at that point. I mean, they've been shorting, probably fading since 150, and this blew them out at that point. And then I see what looks to me like a large seller come in, and I start to see this feeling of just a brick ceiling for about 10 minutes when the stock is doing a ton of volume just off the open. So that was the fade entry. And as it broke down, I was able to actually cover some in the 157 to 158 area after covering just a little bit above 160 and 166. So the point that I really want to get at here is my idea with this position as it started to trace out this triangle is that I thought coming in that it probably would be a triangle at a force. And this also gives you a sense of just patterned behavior in markets, that you can foresee something triangling out in this situation because you've got a lot of buyers who are coming up underneath it. They just couldn't keep pace with this advance. And they're going to start fencing it in here, and most of the time when you get something that's a move this sharp and this robust in a market like this, you're going to get a situation where you're not just going to reverse. If it's going to reverse, it's first going to form a lateral consolidation or a correction through time. And then it's going to break that out a bit further before it can possibly reverse. And so that's what we had here. And I was actually looking for this triangle well enough to be able to cover the rest of the short right here on this last leg. Once I saw this low come in where it did, that's what basically cued me in on it. And when it comes down, I would look for the long here. I actually got in and got shaken out, and I'm really kind of still frustrated about that because I knew what was going to happen, and I didn't manage to carry the position. But this is the secondary entry on the same idea. Once I switch to the long bias, that's the secondary entry that I want to be looking for. This is after it breaks out of the top line of the triangle, consolidates for a bit above it, and then starts back up to the key level, which was 175. So I'm going to use this initially as a jumping off point here to get into a topic that I think is a really key concept, and that's something that I base a lot of my pattern trading decisions off of, and it's strong hands versus weak hands in the market. Okay, the way I've defined it here, a strong hand is somebody who's going to place an order in the same direction of existing positions on movement against that position. So basically, if it's a strong-handed buyer, they're going to be buying, right? And they're not looking to turn around and get out if it goes down a little bit. But if it's a weak-handed buyer, somebody who's going to place an order in the opposite direction of the existing position on movement against that position, it's somebody like me, a trader. I mean, as traders, we're weak hands. So you buy. If it doesn't work, you sell. And if you don't do that, you end up blowing out your account. I can just about promise you. You may make a little money for a little while, but in the end, if you try to be strong-handed with a leveraged day trading approach, then there's only going to be one result for you. So we are weak hands. We're traders. Strong hands are value investors, pension funds, long-term players, value buyers. Think about somebody who's going to buy something because it's gone down a lot, because they see the value to the company being, not because they believe somebody else is going to believe there's value there, but because they see that, they're willing to buy this here forever. If it goes down further, hey, what a great thing. It's just a better bargain. They'll buy more. If it goes down further, that's fine. They'll buy more. If it sits there for 5 years, that's fine, because they believe they own the company at a value price. That's the definition of a strong hand, right? Traders aren't going to act that way, and if they do, they're not going to work out well as traders. There's one thing to note here, which is that strong hands become weak hands if price moves far enough against them. And we saw this in 2008, and we've seen this. We certainly saw this again in 2011 in the fall, where you've got people who believe that they're fine with their position and they'll buy more as it goes down, but things get just so out of hand. John Paulson in Bank of America and Hewlett-Packard comes to mind. But things just get so out of hand in the market, the pain is too much, they shift, and they become weak hands, and they start to deal the position, and they deal it into new strong hands, and that's called capitulation, when strong hands deal their positions into new strong hands. Because those new strong hands, they come in and they get a better price than the original strong hands, and they're willing to buy even more if it goes lower. And that big shift is really what a major decline is all about. It's getting that process to kind of carry through. So really quickly, and if you watched the last webinar I did a couple of years ago, and I'm going to reference that more in a minute, you'll recognize this part, and I'm actually stealing from that. But I think it's a really good example. So imagine this theoretical market, just to get a better idea of what I mean by trading and evaluating patterns on the basis of thinking in terms of strong hands and weak hands. This is obviously a huge simplification of a market, right? But the long interest, as I played it out here, is a bunch of strong hands. Imagine the S's equal strong hands. So a bunch of strong hands. This is a tiny market, only a few participants. A bunch of strong hands and a couple weak hands. The short interest is a single strong hand and lots of weak hands. Okay? So the short interest is mostly weak-handed. The strong interest is mostly long-handed, strong-handed. Now, if you imagine that market, the first thing that's clear about it, no matter what the pattern is, as it's tracing itself out, it is a situation that's an untriggered positive feedback loop of buying. It's already there. That's a dynamic that exists just on the basis of the positioning that's in that market, on the basis of where the strong hands are versus where the weak hands are. What you have is a prepotent uptrend. Because the second this thing breaks higher, the weak hands are going to start to close their positions. However, if it breaks lower, the strong hands are just going to add to their position. So if you have a sideways range in this state, Obviously, it's impossible to know absolutely for sure which state you're in. So this is very theoretical example. But if you think in these terms, you can kind of learn to see patterns a bit better. If a market happens to be in this situation, then you know where it's going to go, because eventually it's going to get nudged just above that range, and the shorts are going to start to cover. And the Netflix example that we looked at kind of gives you an idea of what I'm talking about there, because what I was looking at for this triangle breakout was basically that situation where I believed that the strong hands had been marching up underneath this thing, and it had done enough correction in time to suck in plenty of people who are looking for it to revert to the mean and correct, because that reversion to the mean could be an awfully long ways down for people who are just simply thinking in terms of reversion to the mean. But in this case, I believe that the weak hands were short and the strong hands were buying. And this triangle was essentially, to me, that situation we just looked at. An untriggered positive feedback loop of buying. And so all I had to do on the morning, I can't even remember which day it was exactly, but all I had to do was come in and buy on that break of 175 once that pattern had matured a bit, and we got that pop. We got about 7 or 8 points on it, and it looks like I left quite a bit on the table, maybe another 10 points. But that's a good example for thinking about those concepts. And here's another example for thinking about these concepts. This recent move in Baidu that I've been posting on quite a bit. Big gap down off of earnings, solidly in a bull market context. Right there, that has me thinking, once I see it stabilize the 95 level, I'm looking for a bounce. I bet a lot of other weak-handed traders are looking for a bounce, because you think that big gap down, that big run down right off the open, now you're in a situation where you've got a sort of long-term support level. You start to see a big buyer show up, and a lot of people have been flashed out of the stock, and maybe they're not sure they want to be out of it. And you've got a bull market context. You've got a strong market overall. A lot of stocks rallying like crazy. People who've been a veteran at this business, they look for big gap downs on earnings in a bull market as just your almost core buying opportunity. So I watched this thing for a few days with the inference already in mind that I think a lot of traders are sitting in this oversold bounce position. Those are weak hands, so I'm already thinking that. Now, I'm not thinking that there's going to be a lot of people who are shorting this stock at that point. Again, because of the context. This is just an inference, but I trust it. So the concept of strong-handed order flow, it also applies to the distribution situation. In other words, the people who are selling this stock, if they're strong-handed enough, they're not going to start buying if it goes up. And they don't necessarily have to be shorts to be strong-handed sellers. They can be people who've been sitting in a position in this thing for a long time. Earnings came out. They're worried about this other factor, which is Alibaba doing a search engine over in China, which increases the level of competition for that same niche. And they're going to go into distribution mode. And that's strong-handed selling too. So we've got weak-handed people on the bid. We've got strong-handed people on the offer. I see this thing go sideways for 2 weeks in the same type of pattern in a situation like I've just outlined. And here's a picture of that. And when I see this sort of situation, I really believe you can look at this and just see what's coming. I mean, you can see the situation where all of the weak hands are basically about to give up. And the strong hands, unless they just run out of supply, I mean, it could just magically happen. But the dynamic that's going on there suggests a downside panic move. And that's basically what we got. And I actually feel bad about it because I got shorted about 4 times inside of that 95 to 95.50 range. And the one time that I needed to stay with it was right in front of when China was coming back to open after the Chinese New Year, after the 3-day weekend, and I didn't want to hold a short in a Chinese stock through that. So I ended up having to jump back in the next morning when it was down around the 92.75 area. And I held it for just under 90. Could have gotten more on the downside there as well. But it offers another good example of just thinking in these terms. In a bull market, you get a big gap down in a kind of momentum stock. That can certainly come shooting back up. Could have busted through the 100 level. Could have ripped all the way back to 105. We've seen a lot of stocks react that way over the last month and a half. So when you see something where you feel like maybe that should be going on, and it just looks like it's trading under a lead blanket, that tells you that there's something else going on there, and you've probably got a lot of weak hands that are piling up on the bid, and that tells you that you've got that untriggered feedback loop in the other direction. And we saw that unfold over recent days. Okay, hopefully this isn't too incoherent. Now, I want to shift gears a bit and just quickly go into using sentiment data, which is another thing that I use quite a bit in markets, and you see me talk about it a lot in my daily notes column and in my chart book and in some of my comments. And I just want to quickly flash through that. And the real point, the reason why I use sentiment data, it plays into the same concept of strong hands and weak hands. It plays into understanding the underlying positioning dynamic in a market. And the real point is that people are bullish when they're long, and they're bearish when they're short. It's not the case, in other words, that people are bullish when they're flat and about to buy. And I don't think a lot of people realize this, but there have been a number of studies on this dynamic. And if you think about it in your own past, you realize that you tend to talk to your friends about something you like a lot after you buy it. You don't sit there liking it a lot and not acting on that. You like it, like it, like it. You go ahead and make a psychological commitment to it when you put capital in it. From then on, there's a part of almost like an internal self-defense mechanism that kicks into gear, and you start to like it a lot more because we all like to like the decisions that we make. And so people tend to get more and more bullish after they get more and more long. And people get more and more bearish after they've sold everything because they've committed to the idea that the market's going to go down. So when you look at data about what people expect in the market, I believe, and it's proven out to me over time, that this is actually data about what people are doing in the market. No matter what the price of the market is, when you see everybody bearish, that probably means everybody's already sold. And when you see everybody bullish, that probably means everybody's already long. And when lots of people are all expecting the same thing, that thing becomes almost impossible. This is another important insight. When everyone's sitting long looking for the market to go up, the supply of potential buyers is at that point probably exhausted. And we've got some of that going on right now in the market. I don't think it's necessarily all that related to news or the Fed. I think these are things that people knew by and large. And what's happening right now is just a corrective movement that has to happen in any trend. And when people get leaning all in the same direction, we need to refill the set of potential buyers by seeing some selling. And I just want to call it one more time to that previous webinar just so you can see it, because I go into a lot more detail on this as well as the weak hands and strong hands and a lot of things. And I just want to point to you where you can find it. If you go on the site on briefing.com and you search under the ticker search and you search for the ticker style, okay, you're going to see, if you scroll down a little bit, you'll see my trading style post. And in that post is the link. But here's the actual link right here as well. And again, this is probably a more in-depth webinar than the one we're doing now. And I encourage you to check that out because I think that some of the ideas there don't really matter that it was in 2010. It's still more of the same type of concepts and logic that I think I've found to be really useful over the years. Okay, now quickly, sentiment data. I use the surveys. The American Association of Individual Investors is very good. Investors Intelligence and Hulbert are more about newsletters. So I actually prefer the American Association of Individual Investors because what it shows is individuals saying, here's what I think the market's going to do, rather than newsletter writers saying, here's what I believe you should do, which is a different concept because there's a different process of committing to an idea. So I like the AAII probably the most of the surveys. The options data, the most important options ratios to me are the robo ratio, which I'll talk about more in just a second, and the lobo ratio, which is the large traders version of the robo ratio. And I also use Ridex fund flows, although less and less, but sometimes this can really happen. This is like really liquid mutual funds, and people can just pop in and out of them, and when you see a ton of assets flowing into their bull fund versus their bear fund, it can sometimes indicate some things. So when everybody's taken everything out of the bear fund and the market has gone down a ton and that thing is just empty, you know, it's an inference that maybe you've got a long ways to go still. But if you've got a situation where everybody in terms of the same price pattern, has piled all of their assets into the bear fund, then maybe you're at a low. And as far as resource, I use sentimenttrader.com. It's a good data source. You can find this stuff a lot of places, though. And you can also probably just depend on me to constantly keep an eye out for this and to post on extremes anytime I see them. I review it just about every day. And I'll post in the ETF daily notes as well as the ETF chart book where these things stand. And here's just an example of how to use this, and this is more for larger time frame macro trades. But I just want to point out this robo ratio really quickly here. This is the retail-only buy-to-open options ratio. And basically what it shows is the ratio of small traders opening call positions to small traders opening put options for all equities at the CBOE. And the point is, it's a good way to get a sense of when less capitalized, less experienced traders are all sitting with the same bets in place. And the two red lines, you see the two vertical lines, show you the spikes in this ratio that we've seen over the last year and a half or so. And they both correlate almost perfectly with tops. And they're both in a situation where other things were starting to show an extreme in this fashion. But once you've got all the small traders just storming in and doing this, you want to really watch out for trading on the same side as extremes in this measure. And this is actually caught a really nice swing short in the SPY off of this in October. This comes right on the heels of the Fed's QE3 announcement in mid-September. Right following that, everybody piled into these call options, and then of course, that pretty much we had exhausted the supply of potential buyers at that point. And so we got a nice rollover, and it was a good contrarian kind of setup. Here is basically how that played out. So here's the Fed coming in, powering the market up, saying, here we go with more quantitative easing when this brought the markets to new highs, and I'm not sure a lot of people expected them to be quite that aggressive. But once we stalled out and went sideways, and at the same time we saw a lot of small traders buying options, I thought that it was pretty easy. Right here we put the short on, and we got 8 or 10% on that, and that was a nice situation, and it was educational as far as sentiment data is concerned. And now, finally, I want to point out, if you're used to seeing my chart trader posts, and maybe you don't read the other stuff, I just want to kind of nudge you in the direction of the ETF Daily Notes. I post this each morning about 15 minutes before the open, and this is where I will cover the sentiment data, and I will cover more of these macro ideas, and give my sense of for instance, the breakdown in the NASDAQ 100 today. I posted on that for the last couple of days as a possibility. And the macro picture, the ETF chart book, which is about once every 2 weeks and covers some of my longer-term ideas across asset classes. And with that, if you guys want to do some Q&A, go ahead and just start sending me questions. Let's see how I can. There we go. That'll help. Okay, I'm just getting to the questions now, so I got to take a look at this. And as far as whether I'm trading the stocks or the options market on my trades, I actually trade the underlying equities, and I stray into futures. I have some experience with the options markets, and I have a lot of experience analyzing data from the options market, but I don't do that much options trading because I feel like there are some nuances there that I've developed a lot of nuance for reading price patterns and reading the tape in something. And if I spent a couple years basically working on nuances to the options market, I know my field of play. So, and yes, we will have recordings of this webinar. It will be posted on the Vidler site, I think, by tomorrow, and you can get slides that I've put up here. That's no problem as well. And actually, I do not look at level 2 or level 3. And I know that I mentioned the tape an awful lot, and I used to look at level 2 and level 3 quite a bit. And I've just gotten to where what I do is I sit there on a 1-minute chart, and I just watch the orders going through, and I watch the way that they're hitting the market and where the volume is, and whether it's going off on the bid or the offer. And I just kind of get a sense. I let my mind just kind of dwell in it a little bit, and just get a gut feeling going. And basically, I feel like I've gotten to the point where I can just pretty much read when there's a large position that's being put on or taken off. Style page. The style page is just do a ticker search. Right on the top of the question is, I can't find the style page. Where is the style page? If you just go to the here, briefing.com, right here is the ticker search. If you just go to the style page, you'll see it right here. So you got Growth Trader, Index X, ComDX, Chart Trader. Here's Chart Trader. Right here is the link to the previous webinar. Okay. And hi, Brett. On the 3 screens you have, number 1 has broad market data. What time scale? They're all linked together on the time scale, Ken. And I basically scroll through, and I constantly go from 3-minute, 5-minute, 15-minute, 9-minute, just whatever strikes my eyes where I'm seeing some interesting correlations. Sometimes 60-minute, sometimes daily charts. I'm just trying to look at how the whole puzzle is fitting together in one quick glance. And you know, a lot of times once I have that sense of like what the 9-minute chart looks like, I'll just scale it down to a 3 or a 1 minute and watch it very closely to see if there's anything important that looks like it's shifting. Okay, let me get these out of there, and Chart Trader and ETFXX, there is no difference. They're both me, just I kind of segment the content. The question is, what is the difference between Chart Trader and ETFXX? Either way, it's me. ETFXX is just basically the ticker that I use for my more macro ideas. If I'm putting on and more longer time frame stuff. So if I'm putting on a swing short in crude oil, it will generally be posted under ETFXX or observations that have to do with that kind of play, as well as all of the chart book stuff. If you search for ETFXX under that same ticker search, you can scroll back and see over the last few months the types of posts that have gone there. Chart Trader is more my day trading. And of course, Susan, the Talk to Us feature, can we talk to you about a stock you aren't following that day? You can talk to me about any stock you want. Just go ahead and send it into the Talk to Us feature or to my email or whatever you'd like to do. And I won't be able to give direct responses to your email about what I believe a stock is going to do, but if I find something where I feel like, hey, you bring up a good point, or I see something here too, and I believe that everybody would benefit from my thoughts on it, I will just post it right to the site. With the robo ratio, the question is, where can we chart the robo ratio? Again, I get this from sentimenttrader.com. It can actually be calculated by publicly available information from the CBOE, but Jason Gefford at sentimenttrader.com does a good job of kind of doing that work for you. Okay. Oh, I'm glad you enjoyed it, Charles. Do I prioritize my choice of stocks? I do. I like to look at what's moving. So again, as I showed in an earlier slide, let's take a look at that again. Actually, you know what I can do? Here. So there we go. So right now, here's how I have it organized. There's a 9-minute chart. We'll just keep that up. So here's the discretionary stuff over here. Chipotle, Netflix. I've got the, actually, some of it's not perfectly in order as I constantly trying to plug new things in that I want to watch. So here's the 3D stuff and Herbalife. There's LinkedIn, Target, Walmart, Apple. So technology here, industrials over here with Cat and Joy, materials, steel stocks, natural gas, coal, energy stocks, transports, and financials. Okay, and I'm constantly shifting what's on this, and sometimes it gets behind and I realize I'm not watching the things I should be watching, and I try to plug them in there. And the other advantage to this sort of quote board is that it allows me to, at a glance, see what sectors are red and what sectors are green, see if there's a real slant. So having it organized like that, and then knowing which stocks I'm familiar with trading and like to trade and am interested in. But again, this is a constant watch list. I'm not trying to trade the entire market. I try to take from it a chunk of things that I observe and watch and understand and focus on those things, but enough different things where I can always see the picture of what's happening, where the movement is, where it's just not worth participating. And okay. Okay. Any thoughts on right now on where we are in the SPX? On my chart book that I posted Tuesday morning, I cited a pattern that I thought was important and that I cited actually in the last chart book as well. This is where I write about all this stuff. And you can see this under investing and trading. If you go to ETF analysis, this is the industry insight. I call it the macro picture. And again, I covered the sentiment data here, but I also go into depth on what I think in the long-term picture for the S&P. And what I was looking for that I wrote yesterday is this big wedge pattern along this large resistance level. It's been my experience when you see large time frame wedges that what you usually get is a big pop bar or two that blows everybody out who's been trying to fade it into the wedge, and then you get a reversal back down under at least the center point of the wedge. That's the technical pattern right now. I'm not sure, because you didn't see that robo ratio pop, it has me a little worried that maybe there wasn't a lot of people talking about too many bullish people, but maybe not a lot of traders leaning long. And if everybody's just trying to pick the top, then it's going to be tougher to get that correction. But we did, I'll show you this page as well. So I put this up yesterday and today, and you can really see I did 2 columns on my ETF daily notes in consecutive order: wedge pop, thinking that maybe today I was hopefully going to be doing the other one, which is wedge drop, and it's the pop and drop theme. And here is the focus chart where you see the cash breaking out and popping the top of that wedge. And I thought this may carry through to about 1550 before reversing, but we got the big reversal bar yesterday. So now we're back within that wedge. We're breaking the trend lines, and you know, I mean, in my mind, I'm looking for a move back to the 50-day maybe, and we'll see. It depends on what sort of market environment we have. I think it's possible that we'll be correcting now, or consolidating at least into the end of Q1. I hope that does something to answer your question there. Yeah, how do I determine when stocks are going off on the bid or the ask if I don't look at level 2? I used to look at it a lot, and I also look at it in my own trading interface. I use interactive brokers, and so I'm watching the order flow that way. But I have this little box up here in the corner, and this shows the bid and the ask, and I can see the prices. And as I'm just watching something on a 1-minute chart, I can see where the inside market is. So what I'm trying to do is just feel that sense of how much volume. If it's people just constantly hitting the offer on big volume and the offer is not giving. We had this for a while in racks today, and I tried that on the long side, and I really just couldn't believe how much size was going off on that 55 level. So I ended up giving up on it, and then, of course, it blew out the level without me. But, you know, I know right here, if you can't look at this chart and see that there's a single extremely large seller right there, you need to make that inference when you're looking at a short time frame chart. And I could see huge volume coming in and popping against that seller over and over just above the 55 level. And you see the volume rise and rise and rise and rise and rise, but you only see, let's say, 200 shares showing on that level. You know you're dealing with an iceberg order, and somebody's really got maybe another 300,000 shares to sell, doesn't want to show that size, and wants traders to keep taking it from him. So hopefully that answers your question. I used to use level 2 a bit more, and I've just gotten to where I feel like it's just too cumbersome, and I have a different pattern of just kind of recognizing on a pattern basis, which, again, patterns are more important to me, because if you get too focused on the order flow looking at something like a level 2 or level 3, you can lose sight of the bigger picture. And the more important thing is to constantly pan out to a 5-minute or a 9-minute and just see, you know, here's what's happening over the broad sample rather than one particular instance. So identify your particularly large, important player, but then identify the larger pattern and constantly keep your observations in check in relation to the larger pattern. So I feel like I lost that a little bit when I started to focus too much on something like level 2. Okay, and Brian, which trading platform do I use? I use interactive brokers. For me, I get great executions, and you know, I can trade anything on it, and I don't have to get caught up trying to segment my accounts between a futures broker offering some crazy deal and a stocks broker offering some crazy deal, because the deal's good enough, and the executions are good, and I've been using the same thing for probably about 8 years. So. Okay. The one thing that I'm not supposed to talk about on this is the size that I trade. So I can't answer questions about the number of shares. That's why I always post in terms of generalizations like half size, full size, and it's probably better if you just think about it that way, because I do think in terms of proportionality, and as my capital has changed over the years, I haven't really changed that notion of proportionality. So whatever would be the right type of risk for you in that moment, whatever sort of loss isn't a problem for you to take when you have high conviction on something, you know, that's the risk that you need to be taking, and you need to find the size that will fit for you to put your stop in a place that makes sense to you in terms of the chart pattern. And I think, let me just for a second just talk about placement of stops, because I think that's an important thing. To determine risk, I'm going to just go back to this screen right here. So I could take size on this play, this Netflix short. It would allow me to risk about a 1.5, and that was tough to do in this stock at this time. But I already felt that we've seen 2 spikes above the level, and then we see this lead blanket start to be there, and it hasn't traded like that for 3 or 4 days of sprinting movement. I hadn't seen 10 minutes go by where I felt like there was one trader on the offer that was dominating the stock at a key level. So we see that after we spiked through the level twice. At that point, I'm willing to say it makes logical sense to me to give up on this if after this it still manages to grind up through and get to this area, anywhere near that previous level, because I'm guessing a lot of other people's stops are right here. And so I'm going to front run them and get out below it, rather than get a bad fill at 179 because there's nothing there but a bunch of people trying to cover. So I decide on the size that I'm going to take on that trade based on where it makes sense for me to put that stop. If I'm going to risk a $1.50 on it, then I realize how much size can I take so that a $1.50 is not something that's really going to be that much of a problem for me to take. Okay, it looks like we've basically run the course of questions. Is that, oh yes, sorry, that's California time. I live out in San Francisco Bay Area at this point. So I'm actually in Palo Alto right now, and that's, it does mean really early mornings, but you adjust to it better than you might think. I've been out here for about 1.5 years, and it's very nice. But yes, so I'm on California time. So there you go. 6:30 is the open, and very nice. 1 o'clock is the close. Okay, looks like that's pretty much it. And I thank you guys very much for staying with me on that. And as I said, we'll make this publicly available probably tomorrow. And you've got my email address, I believe. Let me just go back to that screen here. So you can get in touch with me really anytime. And, it's even okay if we have a phone call and have a chat sometime. Just let briefing know, and we'll work out the scheduling on that. Okay, thank you very much, guys, and I hope you enjoy the service, and drop me a line. Take care.